Hello guys and welcome again to my channel. So let's continue the illustration and the answers. Of course, I have to give you a little bit of where we are. So we started with an illustrative problem. And that illustrative problem that I've told you, we made general journal entries and the adjusting journal entries. And after that, the general journal entries are put into the accounts. So here are the T accounts. I have rewritten them into bigger version so that we will not already put a picture here of the small versions of the T account. So we have here, this is for you. And if this is still small, I would like to request that you go to the settings of the YouTube application and then you find there the quality. You select 1440p or 1080p. It's up to you. So that this will be viewable. Okay, or else you use laptops, you use big tablets with big screens so that you can see them. Okay? So, why is it that we are here again in the T accounts? Actually, when we have our T accounts, we posted it and made an unadjusted trial balance with the completion of the worksheet. And then last episode, um, we completed the preparation of the financial statements, which is step 6 of the accounting cycle for merchandising entities. Okay? Now, let's have the question again. Why did I rewrite the T accounts again? Because this is needed for the step 7. Because step 7 is actually posting the adjusting journal entries to the ledger. Actually, the complete step 7 is adjusting journal entries are journalized and posted. So supposedly, on step 7, we are still to make adjusting journal entries. However, earlier in the past videos, I already made adjusting entries together with the general journal entries because I said these are necessary for completing the worksheet and step 7. And here we are in step 7. Okay? So supposedly you are still to make this, and then after making this, you have to post it. Okay? And since we made this already, let's post it already. So what will happen? Salaries expense. Let us find the salaries expense. We do not have. I checked earlier. We do not have. So we have to make a new T account for salaries expense. Again, we are now at posting. Salaries expense. I guess we could make this a little bit smaller. Salaries expense is 73,000. And we have salaries payable. So we don't have any salaries payable also. So let's put a new T account for salaries payable. So salaries payable is credit 73,000. And then we have insurance expense. I guess we don't also have insurance expense. Let's put it right here. Insurance expense. Insurance expense. So on the insurance expense, we have 2,000. Let's make it smaller. Okay? And then we have insurance advances, we have to deduct 2,000. So we're through with this, we're through with this. Next is the depreciation expense. And I guess we did not make any the account for depreciation expense yet. So let's make one. So depreciation expense. How much? It's 7,500. We put that right here. And then we have accumulated depreciation building. It's on the credit. It's 3,000. So we have to add, the previous balance is to 50,000. We have to add 3,000. Okay? And then, we have accumulated depreciation equipment. So we have a previous balance of 200,000. Let's make this clear. It's 3,000. And we have 4,500 here. Okay? So meaning, this has already been posted. Actually, step 7 is just like that. And then afterwards, we're going to get the adjusted totals after the adjustments. Okay? Next is, we have supplies expense. We do not have any account for supplies expense. So let's make one. Supplies expense. So supplies expense is 24,000. And then credit supplies, 24,000 right here. And that's it. And we have a new account title that we don't have any account yet. So let's start with merchandise inventory beginning. With a debit of, this is for income statement by the way. So the merchandise inventory beginning for income statement is 426,000. And then the merchandise inventory end, which is on credit, again, this is for income statement. We have 453,000. Whereas the balancing figure of 27,000 will be debited. Yeah, it will be debited here. So the previous balance is 426. It will now become 453 later on. So we have already posted the, what do you call this? Adjustments to the ledger. So what will happen? After posting it to the ledger, we will have a balance already of these accounts. So earlier, when we did not yet post this, what is reflected on the T accounts are the unadjusted balances. Because if you remember, on our first posting to the ledger, we did not post the adjustments. Okay? But this time, since we posted these adjustments, the balances right here will become the adjusted balances. Okay? So, let's use the other color. So, this will still be 763,450. This will still be 387,000. However, the merchandise inventory will become 453,000 already. From the merchandise inventory beginning balance of 426, it will become 453, and that is the right balance for merchandise inventory. Because again, when the problem was given, it is said there that the ending inventory is already 453. Okay? Now, as to the supplies, according also to the problem, it should have been, the supplies on hand should be 7,000 only. So, the adjusted balance is 7,000. Everything remained the same except for those that were affected because of these adjusting entries. Like for example, we have depreciation expense, this one. We have the insurance expense, this one. We have insurance advances here. If we are going to total, that's only 46,000. The land will still be the same. The office building will still be the same. The office equipment will still be the same. The sales discount will still be the same. The freight out is still the same. The sales returns and allowances will still be the same. The purchases, what is this? Why did I put? The total should have been 232 right here. It's still the same. The freight in is still the same. The interest expense is still the same. The representation is still the same. The drawings of the owner is still the same. The salaries expense, which is new, will be 73,000. And then the supplies expense, which is new, will be 24,000. And then the new ones for merchandise inventory beginning is for 26,000. The accumulated depreciation for building is now updated to 253,000. And the accumulated depreciation for equipment will become 204,500. The accounts payable is still 277. The loans payable is still 1,200,000. The equity is still 1,320,000. And the purchase discount is still at 2,3. 12,000 per purchase returns and allowances. This is a new amount for merchandise inventory and income statement. The salaries payable is also new. So that's the balance, and then the sales will still remain the same. Okay? So those are the adjusted balances. Some of the balances were not changed. It's because it has not been adjusted by these adjusting entries. And some were changed and some are new. Okay? Actually, these balances that you can see right here, this should be the balances on your worksheet on the adjusted trial balance. So in the worksheet, we have 10 columns. The adjusted trial balance is in the fifth and the sixth one. Okay? So when you see there, if you wanted to look back on our worksheet, supposedly the cash is still 763,450, but the accounts like merchandise inventory should be 453,000 already instead of 426. The supplies should be 7,000 already from 31,000, and the insurance advances should be 46,000 already from 48,000, and accumulated depreciation should have been changed from 250 to 253. Accumulated depreciation equipment from 200 to 204, and so on and so forth. Okay? So that's step 7. So let me repeat step 7. It's just the journalizing of adjustments as well as posting the adjusting journal entries to the ledger. Okay? So that's step 7. Now let's go to step 8. Step 8 is all about closing entries. What is closing entries? Closing entries are made in order for the expenses or the income statement accounts. In general, income statement accounts, but if you want to be specific, the expenses and the revenues and the withdrawal, including the withdrawal, those three will be absorbed by the capital. Because supposedly, the capital is the ending point for those income and expenses as well as the drawings or the withdrawals. Okay? As I have mentioned in the earliest episodes of this series, the capital includes investment from the owner, and then withdrawal by the owner, and then income and expenses. So that's the goal of the closing entries. It's to make that happen. The capital will now include not just the investments but also the withdrawal, the income and expenses. Okay? So how do we do that? We have to close the expenses, the revenues, as well as the withdrawal. So if their normal balance is debit, we have to credit it. If their normal balance is credit, we have to debit it. And then we put it on the capital account. Okay? Okay, let's see. So first, we need to make those closing entries. And that, after making the closing entries, we have to post them in the ledger. The same with, it's much similar with what we are doing with the adjusting entry. Oh no, it's dirty. But it's okay. As long as you can see this clearly. So, let's journalize the closing entries. Again, we are already at step 8. So, The closing entries will first start with closing the revenue accounts or the debits or the credits. So when you close the credits, you have to debit them. The question is, where are the credits? Of course, we have grouped this already. These are the accounts with normal balances of debits and these are the credits. And we're looking for income statement items. So, accumulated depreciation is that it's a contra asset including the accumulated depreciation sa equipment. And then accounts payable, loans payable, and losses equity are all balance sheet accounts. What we're looking for is in the income statement. So these are the income statement accounts: the purchase, discount, purchase returns, and this merchandise inventory end income statement. Why did I say so? If you remembered, in our income statement preparation in the previous video, we needed the purchase discount, purchase returns and allowances, as well as freight in, as well as the merchandise inventory and merchandise inventory beginning to compute for a type of expense in the income statement known as cost of sales. I hope you can still remember. So these three are actually income statement items, as well as this sales. So those are the things that we have to close. The salaries payable is in the liabilities, it's in the balance sheet. It's not included in the income statement. Okay? So, what we're gonna do is, since the normal balance is credit, we have to debit sales. How much? 782,000. Also, we have to debit the purchase discount. Okay. The purchase discount is 2,300. And then we have purchase returns and allowances. It's 12,000. And then the merchandise inventory end, which belong to IS, should be closed. That's 453,000. And we are going to close them in a temporary still. Temporary account title, income summary. Okay? So let's add. Let's find my calculator. So we have sales, 782,000 plus 23 plus 12,000 plus 453,000, and we will have 1,249,300. 1,249,300. Okay? Now, since we closed already the credits, let's move to number 2. We're going to close also, again, maybe I got it wrong. The first one is we closed the accounts with credit balances, the income statement accounts. So, sales, purchase discount, purchase returns and allowances, and merchandise inventory and income statement. So, the total of this is 1,249,300. So, we have another account title, income summary. But, let me tell you, that is just a temporary account. Okay? The second part is actually to close the income statement account still, but those that have debit balances. And since they have debit balances, we have to credit them. Okay? So let's start with, these are all assets. So these are not income statement accounts. Where are income statement accounts? This one, the sales discount, and the freight out, and the sales returns and allowances, because sales discount and sales returns and allowances are actually needed in order to get the net sales. And if you can remember our income statement in the previous episode, we have recognized the sales discount and sales returns and allowances as deductions to gross sales. So sales discount, freight out as OPEX, and sales returns and allowances are income statement accounts. We have this one. We have freight in. There are a lot. Interest expense, representation expense. It does not include the drawing. We have salaries expense. We have the merchandise inventory beginning because again, it's necessary to compute the cost of sales, which is an income statement account. We have supplies expense. We have depreciation. We have insurance. Yeah, that's it. I guess that's it. So as you can see, it's very important that you really group the accounts with debit balances and the accounts with credit balances separately. Okay? So let's start with the first asterisk. We have sales discount. Again, since the normal balance of sales discount is debit, we have to credit it to close it. So sales discount is 20,850. And then the next one is the freight out. It's 3,000. And then the next is sales returns and allowances. Sales returns and allowances is 43,000. So we're through with the first column. Let's go for purchases or gross purchases. We will have 232,000. Actually, there are a lot. Aside from purchases, we have freight in, 2,000. And after the freight in, we have interest expense. Interest expense is 8,000. Oh no. Next is representation expense. I guess we will need more space. It's 9,000. After representation, we have salaries. The salaries expense is 73. Salaries expense, yeah. And then the insurance expense. I'll economize the space already. 2,000. And then we have depreciation. Depreciation is 7.5. And then supplies expense. Supplies expense is 24,000. Oh no. And then lastly, we have merchandise inventory beginning, 426. Yeah. So we have to credit them because their normal balance is again debit. Let me check if that is still recording. Yeah, it's still recording. And then the counterpart, so that it will be balanced, is the income summary account. So 20,850 plus 3,000 plus 43,000 plus 232,000 plus 2,000 plus 8,000 plus 9,000 plus 73,000 plus 2,000 plus 75 plus 24,000 plus 426,000. Yeah? Is it done? I guess so. Yeah. So we will have 850,350. Now here's the catch. In order to know if you are still in the right track after that number 2 closing entry, you have to make sure that the income summary is equivalent to the net income that we have computed in the worksheet as well as in the statement of comprehensive income. Okay? That's 418,000, I guess, plus. So let's see. So we have income summary credit 1,249,300 less the debit income summary account of 850,350. That's 398,950. What? Why? Do we have something that we did not account for? We have sales 782. We have, let me check on what's the difference. We have supplies expense of 24,000, depreciation expense, insurance expense. What did we miss? Let me check. What did we miss? Because supposedly, that should be the same. Let me check our past video, okay? Just wait for me. I can't believe I saved this much money on this item on Lazada. Masaya ako welcome today, guys. So, 2,350. Okay. So what we considered here, so we are not perfect. So we have 782,000, right? And then 2,3, and then 12,000, and then 453,000. That's correct. And we have considered 426. We have 426 here. Yeah. Yep. And then we have sales discount of 20,850. And then sales returns and allowances of 47,000. 47, 43. Let me check. Yeah, it's supposed to be 43. Yeah, it's 43. And then we have 212,000 purchases. Ah, yeah, we're wrong. This is supposedly 212. Oh my god. Because 232 minus the 20,000 that was withdrawn by the owner should be 212. So you have to be very careful. See? See what happened here? So we should minus 20,000 here because 232 and 212, the difference is 20,000. So this will become to 830, 350. So in order to know again, in order to know if you are in the right track, the income summary balance should be equal to the income statement after the second closing entry. So 1,249,300 minus 830, 350. We will have 418,950. So that's our income summary account. So 489.50 is already the same with our net income in the worksheet and our net income in our statement of comprehensive income. So it's okay already. Okay? So if you are sure already, after checking, we have closing entry number 3, which is on the closing entry number 3, we are to close the income summary account. So I am debiting the income summary account here Because if you net these two, credit minus debit, credit minus debit, credits will prevail. So in order to close the income summary, I have to debit it. 418,950, and I'm going to put it already on the Gletz's equity. Where is it? Oh, Gletz's equity. 418,950. So as you can see, the income and the expenses are already close to Gletz's equity account. Okay? And after which, we have closing entry number 4. The closing already of the withdrawal. So, where is the drawing? Here's the drawing. So, since the normal balance of the drawing is debit, you have to credit it. Let's drawing 20,000, and we put it on Gletz's equity 20,000. And because of it, the Gletz's drawing will now be part of Gletz's equity. The income, the expenses, and the drawings are now in Gletz's equity. Okay? Based on the entries. But actually, the step 8 is not only preparing for the closing entries, not just closing the credits or the revenues, closing the debits into income summary, closing the income summary later on, and then closing the drawing. Those are the 4 entries. It's not just this. The step 8 is not just this. It's also posting this to here. Okay? So, what do we do? Let's post it. Like for example, when we talk about sales, where's sales? 782. You have to post 782 here. So, if that's the case, the sales will be reduced to 0. Okay? 0 already. And then the purchase discount, we have to close that also. Let's put 2, 3. And it will now become 0. As well as the purchase returns and allowances, you have to close it. It will become 0. And the merchandise inventory end, you put the debit because here it is debited. It will become 0 also. So everything has already been 0. The sales, the purchase discount, purchase returns and allowances, merchandise inventory, and income statement. The same is true with here on the sales discount. You have to post the credit because the sales discount here has been credited, and it will be reduced to 0. And then it will be reduced to 0, the freight out. And then the sales returns and allowances should be reduced to 0 also. And then we have the purchases. It's credited by 212, so it will become 0. The freight in, 0. Interest expense, 0. Representation expenses, credit, 0. And the salaries expense, 73, credit, 0. And then the merchandise inventory beginning, 426, it will now become 0, including the supplies expense. You have to put on credit, it will become 0. Depreciation expense will become 0 also. And the insurance expense is 0. And lastly, we have the drawings. But before that, aside from making all of them 0, you will put an income summary account, the new one. If you wanted to be proper, income summary. What is the first entry here? The first entry is this one. 1,249,300. And then the other one, 830,350. So again, the total of that one will be 418,950. Okay? But later on, you have to debit it, 418,950. And then this will be reduced to 0 because it will go to Gletz's equity. Where is Gletz's equity? This one. You have to put here 418,950. And lastly, we have the drawing. you have to credit it because it's credited here. So it will become 0. But Gletz's equity should be debited by 20,000. So the Gletz's equity will now be changed. All the income, the expenses, the income summary, as well as the drawing has been reduced to 0 because of these closing entries. The only thing that's left is the Gletz's equity. So 1,320,000 plus 418,950 minus 20,000. We have 1,718,950. And in order to know if you are correct, if you are in the right track, you have to compare this on our financial statement of changes in equity. If the capital balance end there is 1,718,750 also, then we are in the right track. Okay? So next will be the step 9 and step 10. I will cut this video short so that it will be not very long for you. So if you wanted to know more, you can look at my next uploads. And then if you wanted to know more, you can also go to my previous episodes and master the foundations of accounting so that you will not have any problems in the higher accounting. So if you learn, please click like, subscribe, and hit the notification bell and share this video to those who need it or those who want it. See you on the next one.